Welcome to the C-Suite podcast and to this special episode made in partnership with Instnt. Our topic today is fraud. Now, that's something everyone in financial services is talking about right now, and for good reason. As fraud becomes more sophisticated, what's really interesting is that it's no longer just about detecting and stopping it. It's about how you protect customers without slowing everything down or without holding back growth. So today, we'll explore how leaders are navigating this balance and why some are starting to see fraud in a completely different way. So to explore this, I'm delighted to be joined by Kent Lugrand, who's President and CEO of Instnt Credit Union. Also, Mike Wilson, President and CEO of Members First Federal Credit Union, and Sunil Madhu, who's the founder and CEO at Instnt. Welcome, everybody, and thank you for joining us today. So I'm going to start by setting the scene. And Sunil, I hope you'll help me with this. Instnt specializes in fraud loss insurance. So can you give us the big picture on the impact of fraud on financial institutions?
Something like $50 billion of losses hit the balance sheets of financial institutions in the United States. And fraud was not insurable. And I should be specific. Identity fraud was not insurable. Fraud is a big word, obviously. And when we talk about identity fraud, it's basically all the fraud that happens when we sell digital products online to consumers. And that includes synthetic ID fraud, which affects all credit unions and financial institutions, where people use completely made up identities to walk through the front door. Then there's third party fraud, which uh, basically stems from 5 times the US population's data having been already stolen. So you can buy someone's entire, bank account details, including their bank balance information, for about $2.50 off the internet today. And then there's first party fraud, also called friendly fraud, where it's, real people that take loans out with the intention of never paying the loan back. Then there's account takeover fraud, where people will guess your password or use some sort of scam to get your grandmother to give them their account password so that they can then use to attack the account. So AI is actually exacerbating all of these different types of fraud attacks. And we're seeing an inundation, a huge spike, in fact, going into this year of a variety of different types of fraud loss exposures to credit unions and financial institutions alike.
Yeah, well, thank you for painting that picture for us. I think it's a pretty clear one. And Kent, we heard some quite stark figures there from Sunil. So we know that fraud is increasing. And we know also that customer expectations are increasing. And that puts financial institutions under a lot of pressure from two different sides. So what do you see are the forces that are driving this dynamic?
Well, I would say the biggest force is humans themselves and trust. We are kind of designed in such a way that the default way of being is to trust authority, is to trust structure, is to trust each other. And so what makes fraud possible is the trust that you bring to the table. And bad actors take advantage of that in a huge way. It's one of the things that they're counting on. But secondly, for financial institutions, it's where the money is. There's this saying, there's this old bank robber from the early 20th century by the name of Willie Sutton. They asked him, "Why do you rob banks?" And he said, "Well, that's because that's where the money is." Well, financial institutions, that's where the money is. And so the easiest way, not necessarily the smartest way, but the easiest way to get your hands on money is to fraudulently steal it.
Right. And so can you tell us why this is creating such a perfect storm for financial institutions and particularly for credit unions?
The biggest component of that perfect storm is the fact that when you're a victim of fraud, the default understanding is that, well, it wasn't my fault, regardless of whether it was or not. And you need to make me whole. I mean, there's just this automatic way of being is that, well, I put my money in your financial institution and it was absconded, and therefore I want my money back. And so because there is that sense of security and safety around financial institutions, then it becomes extremely difficult for us to be able to, in a safe way, give our members and customers the access that they would like to have in this new digital world. At the same time, trying to protect their monies from bad actors and their own bad behavior in a way that will not have us being the one without a chair to sit in when the music stops.
I mean, I'd love to add to that as well. I think the kind of post-pandemic effect is in full blast here, specifically on credit unions, which have been rapidly digitizing as they switch from traditional brick and mortar businesses to digital businesses, looking for young members, and the transition from being able to meet your member at the retail location where you can meet them and get to know them versus some anonymous identity online that's signing up for something that you can't see. I think that's the other aspect that's exacerbating the problem.
There's a component that I would add to that as well. I mean, going back to the two factors that were already mentioned with relation to trust and the consumer really not being held responsible for the losses. But there's another dynamic here that's also evolved rapidly in that, when the pandemic forced companies to have to work and think differently, so many people went to work from home. And so they communicate digitally now and they work very, very quickly in the interest of trying to keep up with the sheer volume of things that come their way. And so the consumer is also not paying attention and just, clicking very quickly on things without inspecting them. And why not? Because they're not responsible for it at the end of the day. And so it's really put a burden on financial institutions to double down on their investments in technology that can help to prevent these things. And it's still cheaper than eating the losses, even though it's a tremendous amount of expense.
Yeah, I'd add to that. All of us want to give our members, our customers, as a consumer, I know I want it. We all want those frictionless one-click experiences. I want to be able to get that loan with one click. I want to be able to open that checking account with one click. The reason we can't get these experiences today is because of the fear of fraud. Fraud is not linear. So a 2% increase in acceptance rate could result in a 20% spike in fraud. So, having insurance add that protection for credit unions and other institutions allows us to give members those frictionless experiences without having to be afraid of the fraud loss anymore.
Well, and Sunil, I would propose that it is more just than the fear of fraud loss. It is the actual fraud loss itself,
Absolutely. Yeah.
right?
It's the loss and then the OPEX, right? Because there's like $6 of cost for every dollar that ends up in a loss. So it's, yes, a tremendous problem.
And sometimes it's the mindset of the institution. I'm a relatively new CEO, but I've been in the C-suite at my credit union for 10 years, and for 7 of those 10 years, I would often hear, "Well, that's fraud. That's the cost of doing business." But until you take a proactive stance and say, "No, this is not a fraud problem. It's an enterprise problem, and we're going to really do something about it," it can make a tremendous difference for the institution. Has for us anyway.
Yeah, actually, Mike, I'd like to dig into that a little bit and talk about the operational perspective
Sure.
and what you've been doing with that, looking at fraud as an enterprise problem, that scenario you described.
Sure. And it's, I'm a very transparent and candid person. We're a fairly large credit union. We have 630,000 members. And we're a little bit unique in that out of 4,400 credit unions in the country, we are one of 15 that actually own and build and develop its own mobile app and online banking platform. And so we have, on any given day, well over 500,000 active daily users on that app. And, with account takeover fraud emerging and very rapidly several years ago, this was an issue that we needed to take seriously. Otherwise, our fraud losses were just going to continue going through the roof. And this was probably one of the first challenges I really had to tackle in my tenure stepping in as a new CEO. And, what I saw, at least at our institution, everybody would get frustrated and say, oh, fraud's not doing enough. Fraud's not doing enough. Well, fraud departments only have so many resources, number one. Number two, the tendency at financial institutions is typically to hire somebody with a law enforcement type background. And they will tend to want to focus on what I'll just call sexy cases. But the real volume are in these other things that are not quote unquote sexy cases. And so, they have a tendency to allow things to pile up that they don't get to from a volume perspective. And what we decided to do was, again, let's look at what we have in terms of scalable solutions. We formed an enterprise task force. We involved everywhere from our call center to our branches, to our online banking unit, and our cybersecurity and fraud areas. And what we started to do was look at patterns and behaviors that we knew were known fraud losses, and we started journey mapping from start to finish the entire process. Then we put rules and kill chains in place based on those patterns, and it tremendously cut our fraud losses. And while that may be a little bit easier for us to do since we can see everything, owning and building our own mobile app, we've still done a tremendous amount of work trying to educate peer institutions. They can take that same formula and put the burden on their third-party vendors that they use for these services and demand the same kinds of protection. And what we do know is that fraud is always going to evolve. So while we may have cut our losses to a point where they're a third of what they used to be, and that's very meaningful, our task force remains intact because we know they're going to try another method, and we're doing the best we can do, making the investments we can make to try and stay in front of that.
Yeah, it's always a cat and mouse game, right?
Right. But we moved some where the volume was. We moved the bulk of that to our call center, and we built out an entire unit with its own discipline called the Fraud Squad. They have a blast with it, and they're tremendously impactful. And we moved another area to our cards area, so our true fraud folks now are not bogged down with such volume that they can't make a difference in cutting those losses.
Yeah, and that it brings an interesting point to bear. The biggest control I've seen selling tools into the market has been that it's the trade-off that you do for growth that keeps fraud down.
Mhm.
If all your institutions accepted all of the customers that you're marketing to, that you're spending money to bring to your doorstep, if those members were all accepted, it would completely blow out the equation of fraud management. It just would not be manageable. So the biggest control that everybody uses is to say no to growth, to trade off growth for safety. And so our thinking is that paradigm can change. You don't have to tell your members, hey, I'm going to punch you in your face or I'm going to punch you in the gut. You've got to pick where you're going to get punched because that's the trade-off, the friction for the risk in compliance, the governance layer, the protection, right? Well, I don't think we need to think in those terms anymore because we can think of this problem as every other insurable problem. We can give those experiences with the insurance protection.
So it's interesting the approach that you're taking because it is an approach that I think deserves a look. I agree with Michael that it is an enterprise problem, although my institution is a fraction of his size, so I don't have the resources to be able to develop my own fraud team. However, we've decided that because it's better to partner with specialists than be all things to all people, we're looking to those third parties to help us do exactly that. But we also recognize that although a member may want a frictionless experience, it's also analogous to driving a car without brakes. Driving a car without brakes is completely frictionless, but no one would want to drive a car without brakes. It's being able to use the brakes when you need them, use them at the proper time in order to reduce the risk substantially. One of the trade-offs we make is not necessarily a trade-off between growth and risk, is a trade-off to determine is the juice worth the squeeze? In terms of if it is, then it does no one any good if we put all these roadblocks in place and punish the exact members and customers that we're trying to serve. So there's got to be a trade-off there to where it works well for everyone, but increases the throughput of the benefit.
For sure. I think that makes a lot of sense. I mean, I like to tell people if there was a paradigm where, fraud's going to happen, it's normal, but there are no losses to fraud when it happens. If fraud has no losses, would anyone care about the fraud?
No, I don't think so.
That's the key right there.
Or they would care in a different way. It's just like any sort of complex connected system. You make one change over here, it breaks two things over here. So it would move and shift, but the financial pain would disappear, which would be
Yep,
huge.
that's right. And I think it's time that we change the economics of fraud because today they're wholly in the favor of the fraudster.
Yeah.
Oh, that's an interesting point, Sunil. Can you talk a little bit more about fraud from a financial perspective and that idea of changing the kind of financial paradigm, I suppose, of fraud?
It's the well, see, I say fraud is normal because fraud is a crime, and like all crimes, you've got motive, means, and opportunity. So if you say the motive is to make money, well, that's a constant. The means is to exploit technological complexity to commit the crime. Well, that's a constant because we're in a digital world. So if those two things are constant, what are you left with? The opportunity. That means that any person given the opportunity to commit fraud under the right circumstances will commit fraud. And we've been trained to think of fraudsters as people with balaclavas sitting in dark rooms. It's not that. Think of you walking down the street and there's a Citigroup ATM and the ATM's malfunctioning and it's spitting money out into the streets. How many good people who do not think of themselves as fraudsters walking by that ATM will take the cash, stick it in their pockets and keep walking versus running into the bank to tell them, hey, your ATM's malfunctioned. This is the nature of fraud. Fraud is normal. For us, it's not so much will fraud stop. Fraud will evolve in different ways and forms. For us, it is what can we do to diminish the impact of fraud, the cost of fraud, because the economics today are, I don't have to commit fraud myself. I can actually pay someone to commit fraud for me. Fraud as a service is the thing on the internet. You can go to it's not so much even the dark web, the regular web. You can go search for the word Carder Forum, CARDER FORUM. There are hundreds of sites that will come up. If you click on any of them, you'll see there's banner advertising for fraud. People selling, MCTN numbers for Western Union money transfers that you can steal. It's crazy. So it's so easy and cheap. And the fraudsters don't have to obey the law. We have to sit within kind of, in the way we fight fraud, we have to follow compliance and governance regulations and privacy regulations. Fraudsters don't have to care about any of that. So the advantage is wholly in their favor, and they only have to get it right once. They can bombard your credit union over the course of a month, trickle feeding you fake IDs, 3 IDs every day that your system won't see it as a drip attack. And it'll create a dormant account and they'll fund the account and then they will use the account to commit crimes later on. It's very difficult to shield yourself against these kind of types of attack without employing AI, real-time systems, etc. And it's very hard for credit unions specifically as nonprofits to have the resources of a for-profit bank with the people and the processes and the technology to overcome that. And this is why we try to apply technology and AI versus the AI, where the new AI solutions can help credit unions and financial institutions that do not have those resources to combat the nature of fraud.
Right, for sure. And can you tell us maybe a little bit more about what the solutions look like?
I mean, it's for Kent and Michael to actually talk about because these guys are the experts protecting their credit unions. What are some of the solutions you guys use?
Well, I can tell you from my view that basically what you're talking about is solutions to correct the human condition, right? Because I agree with Michael, it is an enterprise problem because it's a human condition problem. And so the the solutions today are either you limit your exposure or through uh, uh, taking a protection first environment, or you try to use the technology that's available today to help you be effective. So I honestly believe today that you cannot fight AI fraud without AI. It has become so sophisticated, even to the human ear. You can't tell the difference between what's real and Memorex, going back to my old days. And so it is to the point in technology development that you really have to use technology tools to be able to fight technology tools. And so I don't think it's a choice of if you choose. I think it's a choice of how much pain you're going to experience before you choose, because I don't think there's any other way in this digitized environment. Because as Michael said, they're consumers are being inundated with so much, so fast, and we're asking them to make so many decisions on so much information so fast that it is a recipe for fraudsters without some uh, technologically advanced thinking controls in place.
On our end, it was really more about, there's so many various forms of fraud, and you only have so much time of the day and so many resources. So when you take that enterprise look, it would behoove any team to basically look at where are the biggest losses, break things up into different categories and buckets, and then prioritize the measures they can put in place to offset some of those losses, and then just keep chipping away. There's no really one overall solution that's going to solve this problem. So it's really a matter of, how is your institution run? Where are you seeing the biggest fraud losses? Then choose the different tools that may be available to you to offset those losses. So, we've done a number of things. So I described earlier what we put in place in terms of the kill chains for pattern detection on the account takeover fraud. That was successful. But we have also worked with a provider who scans the web 24 hours a day for known compromised card numbers that circles back with our members. And what we have decided to do is proactively then reissue rather than wait to eat the losses, because it's still cheaper than eating all of those losses. We have also done things like scan the web for fake websites that these fake text messages put out there to try to disguise themselves as the institution. What these attacks seem to come in ebbs and flows. But what we found is by having that technology, when it takes down those sites, it's not one site, it's hundreds or sometimes thousands of sites, because this is a volume game in terms of the type of fraud. So if you can shut down the volume, again, it makes a tremendous difference. And then we also take out advertisement time with our local news networks, and we do it as a consumer safety advisory, where we are on the news constantly talking about how to spot various forms of fraud as a consumer awareness piece. And all of these are a tremendous amount of expense, but they have made a substantial impact where these technologies have actually more than paid for themselves, because we're not eating the losses that we used to eat.
Yeah, I mean, Debbie, I'd say, from a risk management perspective, the principles are the same. How do you manage a risk? You decide not to take the risk, or if you have to take the risk, you try to minimize the risk you take, or you get commercially viable insurance.
Right.
Well, that third leg was not available until now.
Right.
Right? It's a paradigm shift for the market, that this problem that was previously not insurable is now insured by Munich Re and Swiss Re, the world's largest AA plus rated balance sheets. So that is, I think, groundbreaking. And this is new. The program launched in August last year. It's already bound. Credit unions are already seeing the value of it. In fact, we're seeing adoption in credit unions faster than the financial institutions. One of the reasons being that credit unions, being nonprofits, don't have the self-insurance capital reserves that banks tend to keep for a rainy day. And so the capital compression, the fact that they can do more with their CECL reserves for the loans that they're writing without having to call on those reserves for fraudulent credit defaults, because when fraud happens, every fraud is a default. So all defaults, by definition, mask fraud. So when you have insurance and the technology basically says, oh, that looks like it's going to result in a fraud loss for you, and we avoid that loss, well, now you've just freed up a reason for using up that capital reserve on that loan. And so what that allows credit unions to do with the limited capital resources they have is to write more loans, because now they can shift the working layer of the loss from their expected loss from their own balance sheet to the insurance company. And we've gone to the extent of protecting the credit unions with this notion of claims that are denial free. It's a new notion in the world of insurance. We've all bought insurance before. We know how it sucks. We pay the premiums and then we make the claims and it's like, oh, sorry, can't pay the claim. And you know how bad that feels. We didn't want that with this program. We wanted to say, hey, if you're going to move the risk onto Munich Re's balance sheet, well, you want to have a guarantee of payment when the fraud happens. So we engineered that with the world's largest TPA, Sedgwick. I should say they're America's largest TPA. And so they are integrated into the system so that when any credit union within 90 days of the fraud happening files a claim, they're able to get reimbursed within 30 days flat, which fixes their spiky cash flows, makes it a predictable cost for them, and reduces all the operational nightmare that follows a fraud attack. So this is truly a groundbreaking change, in paradigm that will take some time because the industry takes time to progress. But we're seeing a rapid adoption because, everyone is already familiar with the notion of insurance. And Munich Re and Swiss Re are well-known brands that are already reinsuring a lot of the credit unions and financial institutions' risks today.
It would be great to come back to something that Kent mentioned a little bit earlier in the discussion, in that I think your words, Kent, were we cannot run from AI, we need to use it, right? I believe that's what you said. I think it's really important to hone in on that topic because, here we have an example. Obviously, Kent and I are from institutions that are with two different asset sizes, and there's, a correlation there potentially to resources available, right? But AI is the great equalizer in all of that. So many of my peers, perhaps they have one person that's responsible for all of their account opening. Well, guess what's rampant with fraud? Account opening or processing the loan applications digitally. Or another one that's come up frequently is institutions will say, there's too much happening with P2P fraud, so I just shut down the capability with my vendor. Well, don't do that, because your deposit outflows for your members that need that service are probably greater than your fraud losses to the service. So, you want to try to leverage the technology that can really make a difference with these kinds of things. And it does not always mean hiring a bunch of people. You just have to go into it with the mindset of what specific problem am I trying to solve, and what valuable partners are out there in that space.
Yeah, we've taken a different approach in that as well, because traditionally you're looking at managing that risk proactively, as we should do. And so you look to buy the screwdrivers and the hammers and the latest tools to get ahead of the latest type of fraud vector. For us, it's, fraud is normal. You're going to have losses. Now you can have protection when those losses occur. Where, the way the solution is designed is net off the tools that you use, because we believe that asking you guys to go about changing your tooling or your program or your processes, especially in risk management, is not viable. See, there's an actual gap in the market between the hype of AI and the reality of AI. You can't use Gen AI in risk because Gen AI neural networks are not explainable. That defeats the very principle of model governance. How do you tell if the model's got biases for redline, and other types of problems if it's not explainable? So the reality is that in this case, AI will aid the fraudster more than it will aid us trying to defend ourselves from the AI, because we have to follow rules and regulations that govern the use of AI. And we can't necessarily employ AI in areas where, legally speaking, that AI is not allowed to make the adjudicated decision. It has to be a human, right? So these are the constraints that we have to work with. And the AI, the large language models and Gen AI are applicable in a lot of different areas, customer service, customer facing activities, etc. But things like, KYC compliance, fraud management, you can apply the technology as the next type of screwdriver, but you still need human beings in the loop ultimately to decide whether the machine's making the right decision or not. And this is another shift as well, because insurance vendors like Munich Re see themselves as the governance layer for AI, because they're taking the balance sheet risk when the AI doesn't work. For example, if your AI solution for fraud prevention that you've put into your credit union goes berserk and exposes your credit union to liability, the insurance companies are the ones saying, hey, we'll take the losses. They provide E&O coverage, for example, for AI malfunction. So increasingly, insurance companies are viewing themselves as the governance layer for all of these different AI solutions, where they'll say, look, your AI is good, the processes around managing your AI are good, so we can insure you.
Right. And to bring another perspective into that, Kent, what's your view on the customer situation with regard to AI? So what's their mindset around things like digital onboarding as we increasingly use AI, as Sunil was saying, in the kind of risk management and detection processes?
Well, I think when it comes to AI and any sort of technology, it's always slow. It's at least it's my experience. It's always a slow move toward adoption until it hits a critical mass, and then it goes like crazy. And and you can look back at human history, whether it was the horse and buggy to the tractor, whether it was the stagecoach to the train, where there's this skepticism that human beings bring with anything new until there's enough of acceptance, and then it becomes table stakes. I don't think this is a different equation or a problem than that.
Right. Okay. And I guess, Mike, to bring you into the picture here as well from an operational perspective, how can you unlock growth in that more AI-driven environment?
Yeah, it depends on your philosophy as an institution. I would point out, to remember we're a financial institution. We have boards. Those boards serve as fiduciaries to the organization, and they are to provide governance over the strategy and the vision and the execution that the institution deploys. Right. So we wanted to be sort of at the forefront of this as an institution. We see a tremendous amount of opportunity, but there's also a tremendous amount of risk, because we are at a time where we have a federal administration that's encouraging the use of it, but they haven't put the regulations or the guardrails on it yet. Yet we are federally regulated with a whole number of regulations that we have to follow, right? So this is one of those areas where we know it may not be regulated yet, but it 100% will be. And we decided, instead of starting with deployment, we wanted to start with governance. So we thought that would, put our regulators at ease, since we are a little bit cutting edge. So we developed an AI center of excellence. We overlaid that with our strategic plan, our project roadmap, all of our work intake, all of our third-party vendor management. That was a tremendous lift, by the way. And then we took a job description and created an AI officer. We wanted to take that a step further, because I believe that this is going to be one of those areas, just like fair lending, BSA, AML, Internet Security Officer. So we do have our AI officer appointed by the board. They will do that annually. And that we locked down our environment so that we could start to deploy use cases in a secure way, knowing that we'll have a trial and error process. So that was all last year. Now we are in true deployment mode where we've used it for underwriting decisioning, RPA. We actually have 4 AI employees that are doing work that report to a manager. And so we're monitoring the progress of all of that. And then for our executive team, we actually have AI avatars of ourselves that we trained and built. So we gave it personalities, and we're deploying different use cases for that, even through our mobile devices, to make ourselves more efficient each day, and just challenging ourselves to think differently about how we may be able to leverage that technology to do more meaningful work and take the mundane, monotonous tasks in particular off of our plates.
Yeah, I think I couldn't agree with you more, Michael. I think the most important thing to recognize is that AI isn't the panacea against fraud or isn't the panacea. It's just one more tool. And so recognizing it as a tool and using it in a smart way to help you mitigate and manage the risks is just the right business decision to make. And so, depending upon your scope, the risk that you're willing to take, all of these have to be factors, including whether or not you decide to provide insurance coverage. All of those need to be factors to help you deliver the best that you can and the best that you're capable of. I don't know if there are many not-for-profit insurance companies in the world, but so we have to recognize that insurance companies aren't knights in shining armor coming to save us without a cost. They're in the business of mitigating risk to be able to help us be better, but they are doing it in a way that makes revenue for them. So it's one of those opportunities that you get that we're trying to basically take the amount of money that fraudsters have been ripping us off and redistributing that between profits for the financial institution and safety and security, and profits for the members and profits for the insurance company. Because it doesn't work unless we all win.
The good news for you, Kent, is that the reason this is possible is because we've shown the actuarial models to the actuaries that we can operate in a loss ratio corridor at about 30% loss ratio. So that allows us to, basically reduce your exposure and make your premiums cheaper. So we're not trying to steal the money the fraudsters are stealing
Oh,
from you. I just don't want anyone to leave.
that's the
Leave
way I like to look at it. That helps me sleep better at night, right?
And that's precisely why when we engineered this program, we wanted to have denial-free claims. That's an
Yeah.
important thing in the program.
Well, I love what Kent just said, and I know we're speaking specifically about fraud, but what I'm about to say, I want to make sure it relates to that. Much like I said earlier, that our institution took a look at fraud and basically said this is not a fraud problem, this is an enterprise problem. I believe the same holds true with AI, because I do have peers that tend to look right at the CIO or boards that look right at the CIO, but they tend to think a little bit more technical in nature. They want to make sure everything is working, keeping the lights on, all of these things are working, business continuity, et cetera. But what we're talking about here is deploying this kind of technology to help mitigate the fraud losses. And CIOs are typically not conditioned to think that way, perhaps unless they have an internet security background. And so from the insurance side, I also think that it's important for boards to truly understand some of these things can also be self-inflicted wounds, right? Like I've heard stories about peers who have board members that take their PII or they take their, even an Aries file or even board packs and load them up into ChatGPT. And I'm like, oh my heavens, but this stuff actually happens, right? And so it really is important for everybody to educate their boards and to build that governance model and to say, here's how this stuff works, but here are the risks that come with it. And remember, we're regulated, and here's the information that we have a duty and an obligation to protect. And it's really got to start there.
Yeah, for sure. And before we move to our kind of closing questions, Neil, just to bring you in to wrap up that conversation, what do you think some organizations are still underestimating when it comes to the impact that fraud is having on their strategy?
Well, I don't think a lot of organizations are aware of the overall impact of fraud in the macro environment. The chief lending officer knows how much credit defaults they have. The CFO knows the capital ratio and the net interest margin for their loan book, and their take rate. The CFO probably doesn't know what percentage of credit defaults are fraud attributable. I know, for example, the OCC doesn't make a separate kind of legislation that says for your CET1 or your net worth assets, you can distinguish between fraud-related assets and other risk-related assets that are not fraud-related. They just tell you you've got to keep, 11 to 15% of your risk-weighted assets as reserve. But that's changing now because of the advent of liability shifting in this space. And as technologies are smarter in classifying the risk, that's another advantage. Today, most credit unions probably would not be able to tell that that particular default happened because it was a synthetic ID or a third party ID that was used to establish that account in the first place. It just looked like it was a real person, but it is actually a real person whose credentials were stolen and altered. Someone changed their email address and phone number and established the account with the out of band checks going to the fraudster instead of the actual identity holder. So these are things that not every institution is aware of. The dormant accounts that sit inside their existing customer base, the accounts that are used by fraudsters that wake them up downstream and use them for the attack. These are things that a lot of businesses don't have the technology savvy. And now the advent of these AI-driven technologies that can see all of these different signals in real time and help us make better decisions are coming to the forefront to abate this problem.
Yeah, right. And I guess, bearing that in mind, which is really helpful insight, and to close, I'd like to ask all three of you to give us a brief sort of concluding takeaway from this conversation. So, what does a winning fraud strategy look like over the next 3 to 5 years? And Kent, I'm going to ask you that question first.
Okay, well, I would say a fraud strategy for InTouch Credit Union would being able to quantify my risk for fraud, because that will help position me to even be a better trusted financial partner with the members that I serve, as well as being able to financially quantify the amount of fraud that I can take to give me the best opportunity financially to serve those very members who's trusting me. That would be the best outcome that I can come up with.
Yeah, that sounds great. Thank you. And Mike, how about you? What's your take on that question?
Sure. I still maintain that fraud is an enterprise issue, not a fraud issue. And we will continue down that path and maintain our fraud task force so that they can continue looking at what's the newest trend, what does the data tell us, how do we make impactful decisions in real time rather than being so reactionary to fraud losses on the back end. And I also think that while there is great technology out there that we will continue to explore, that will only become even more expensive as attacks become more sophisticated or fraud becomes more sophisticated, I also think there's an opportunity for financial institutions to hold their vendor partners accountable and go back and look at their SLAs that they have with their vendor partners, including their cards processors, by the way, that may get overwhelmed by volume and may just default credit everything. Well, financial institutions have to watch that because it may put them out of compliance with their agreements with whether they're Visa or MasterCard or whatever have you. But going back and look at all of these things, it's not any one thing that makes a difference. It's an accumulation of all of these different actions that you can take that'll really make a difference. And then, the third and fourth part of that is trying to advocate for legislation to give some relief to financial institutions who foot the bill on all of this. That's very difficult to do, and it'll be a slow grind, but we'll keep at it. And then the same thing with consumer awareness, although it doesn't impact the consumer at the end of the day, so they care a little bit less or perhaps a lot of bit less about it. But we still got to do the right thing in educating everybody along the way.
And I'm going to sort of write on what Michael and Kent said. The cost of fraud is growing. So from my perspective, it's less about the tools and stuff, which, you've got to keep improving the layer cake. It's really about the loss. It's about the money. And insurance will protect you regardless of your use cases, the silos, the technologies that you're using. Ultimately, when that fraud happens, insurance is there to protect you. And insurance is not a product, it's risk transfer. So, traditionally that's been done with capital reserves and CECL reserves, which are very kind of capital intensive for your credit union, and it hinders growth. And with insurance, you're really talking about financial engineering, right? The moment you sign the policy, you've automatically improved your earnings, you've automatically improved your margins, you've reduced the P&L drag, you've reduced the over provisioning of capacity, which, because fraud is spiky events, you don't know month to month how much capacity you'll need. So typically you'll put 2x the capacity of the loss. You don't need to do any of that because now you turn that into a fixed cost. And to boot, because you've already provisioned your own resources for your CECL reserves, what the insurance add-on allows you to do without changing anything in your infrastructure, people, process, is give you greater capacity to grow. Every credit union I've worked with, and I've worked with, $10 billion credit unions and $2 billion credit unions, and every single one wants to drive their loan volume. Most credit unions took a big hit in the fourth quarter of last year with auto loan defaults spiking. So many of them started this year writing lesser loans than they normally do. But for most credit unions, in that $2 to $5 billion range of loss, for them, it's the difference of writing $3 million worth of loans a month versus $5 million of loans a month having insurance. So, I encourage, obviously, all businesses to apply the insurance, or at least at the board level, have a conversation, simply because your own risk management programs require that you apply commercially viable insurance solutions to stay compliant.
Well, I would add one so small thing, and that is making the assumption that the price of the insurance is less than the fraud.
That's basically
Correct.
that's actually the problem has to be insurable. If it isn't insurable, obviously we're not talking about anything here. So of course, yes, the cost of it has to be less than the loss, and it has to be less than the cost of capital allocation. So we have the sophistication in pricing to know that it has to fit those formulas. And the good thing is the technology is working at such a efficient loss ratio that we're able to compress the price. So every year, every new credit union that comes on board, every new business that signs up for the insurance makes the overall AI smarter for everyone.
Yeah, I knew that. I just hate unspoken assumptions.
For sure.
Okay, great. Well, I think that's a great point for us to draw this conversation to an end. Thank you to all three of my guests, Kent Lou Grand, Mike Wilson, and Sunil Madhu, for that rich and thought-provoking discussion. And I think one clear takeaway from this conversation is that fraud is becoming a defining factor in how institutions and credit unions can grow, can compete, and importantly, how they build trust in the years ahead. So thanks so much for helping us to unpack those themes today. And thank you for staying with us for this episode of the C-Suite podcast, which is made in partnership with Instnt. If you'd like to join in the conversation with us, you can find the C-Suite podcast on LinkedIn, on YouTube, and of course on all the podcast directories. And we'd love to hear your views on there. Like the episode or follow us and keep up to date with all our future episodes. If you want to get in touch with the show, please head over to our website. That's csuitepodcast.com, and you can send us your inquiry there. I'm Debbie West. If you want to get in touch with me, find me on LinkedIn. Thank you so much for listening, and I hope we'll see you soon.